So welcome to the corporate finance course of this year. My name is Gijsbert Zwart. I will be teaching the first part of these lectures, the first couple of weeks, 4 weeks. And I'll also be doing the on-campus tutorials on Fridays. So what I want to do today in this first videos is first introduce the topic of corporate finance, remind you of some of the stuff that we did before. In the bachelor's program, I will want to say something about what this course is going to look like, and then we'll start probably after a break for you, but that's up to you because there will be different videos. Start looking at the contents in terms of the model that we are going to look at in this course. So this is the introduction basically. So what we know from previous courses, the classical corporate finance basically is that in perfect capital markets, all projects that have positive NPV or net present value will be financed. That's the ideal world, if you wish. If there's a project which has a positive NPV, then we should finance this. We should take a project with an NPV, with a positive NPV. What we also learned in this same ideal or perfect world, that it is irrelevant how a project or a firm is actually financed. And if you remember, this is of course the famous theory by Modigliani and Miller, which says, well, the value of the firm is actually not affected by the capital structures and not by the debt and the equity, the way the firm is financed, but only by the asset side of the firm. So what are the free cash flows that are generated by the assets? That's what determines firm value and nothing on the liability side, if you wish. Now we are also aware that this only happens in perfect and idealized circumstances. And you might know, and can also have a look actually at the survey paper that we put in reading this survey paper by Stuart Myers, that in practice the world is not perfect, and you can figure out basically, or you remember some reasons why actually these results might break down when there are some imperfections. So take a while, think about this. Perhaps you want to pause this video for a bit and think, what are actually the impediments to these ideal world results? Okay, so I hope you did this. You have thought a bit about this. So let's go further to the slides and discuss some of the deviations from perfection, from ideal worlds, that might raise some issues with these two statements. So of course, one of the first ones that might come up to you is that, real worlds, there are taxes. So debt, if a firm is financed with debt, that gets a preferred treatment. You can sort of deduct the interest, as you know, from your tax bill. And that makes actually debt a more attractive way of funding your project, because the firm will get more and the tax office gets a bit less, but who cares, right, if you're running this firm. So though the total cash flows from the firm are not affected by capital structure in this case, the share of the cash flow to the tax office is going to be lower, and that would sort of drive firms to raise debt to large levels. So we should see very large leverage ratio or debt to equity ratios in practice. Well, we know this, certainly there is debt, and sometimes it is actually high. But if you look at the average firm, debt to equity ratios are actually not that high. So there must be more to this. Well, one next step is, if debt really gets really high, then we will also have potential bankruptcy costs. So bankruptcy, of course, has some real costs. You have to reorganize a firm. You have to sort of sell off things which are not that useful anymore to somebody else. But perhaps much more important are actually the informational costs of bankruptcy, or even of near bankruptcy costs. If investors or customers lose confidence in your firm, then they will be reluctant to actually do business with you even before you're in actual bankruptcy. And then there will be renegotiation costs. So even if you know, this project still has some positive net present value, but we do have to do some to restructure in some way the debt, which is too big right now to sustain this firm. Well, you do have to renegotiate. Who's going to bear the loss? And you know that when there's renegotiation, there might be conflict of interest, also conflict of information. An additional point, apart from bankruptcy costs, is agency costs. And there you have seen the very famous contribution by Jensen and Meckling in previous courses, I'm sure. And agency cost basically refers to the fact that those who run the firm, the managers, and those who fund the firm, the investors, they might have different objectives. And capital structure actually will have a role to play in incentivizing the managers to work on behalf of the investors, to make sure that they pursue the interests of the investors rather than perhaps their own interests, which might deviate from that a bit. There's a balance there. So there's a balance between using debt, and more debt means the managers have to sail a bit closer, run a tighter course, provide them with effort to make sure that this firm is going to be more profitable. But you also have to be careful with debt, because too much debt might also result in managers taking too much risk. So there also needs to be some part of equity financing which contains the risk-taking incentives for the managers of the firm. So those are agency costs that were, go back to Jensen and Meckling and even before. Then there might be hidden information. So you've also seen that, or can read about this again in this paper by Myers that I put in the reading list, the pecking order of financing. So if a firm, and it's due to Myers and Majdrouh, so if a firm needs to attract finances, to attract new funding, there turns out to be some sort of preferred order of attracting capital. The first way of attracting new finances turns out to be, in this pecking order theory, is to use sources that are least sensitive to that information which is not observable to outsiders. So one of the least costly ways to do this is use internal financing. So use your own cash flows from other projects to finance new projects. That's a preferred thing that managers of firms wish to do, because then they do not have to make sure that all the information is available to the investors, which they cannot perhaps credibly even commit to. And that is also relatively insensitive to information that financiers, funders might not have at their disposal, whereas managers have this better information position. So that would be sort of next in line. Equity would be very at the latest. Equity is very junior, if you wish, right? It's the last part that gets paid off, so it bears much more of the burden of informational asymmetries between these two groups. It's not a reason why hidden information plays a role is that this might affect signaling incentives for a company. So companies might want to signal, oh, we really have a high value. This company is really worth a lot. And they might do this, for instance, by buying their own stock, right? If you invest your own money into this firm, then you convey a signal to outside investors. Listen, you might not be able to verify this information precisely, but believe me, I'm putting my money in. I'm buying my own stock, so this really is a good company. So signaling might also be a reason why actually funding decisions are going to matter. So the common theme here, if you see this, is about information. So there are information asymmetries between outside investors who are providing the funding for a firm and managers who manage this firm. So what we're going to do in this course is that we're going to explore the consequences of such informational problems, but in a structured, in a theoretical, if you wish, way, in a model kind of way. And the way that we will do this, so the type of model that we will be interested in, is the so-called principal agent model. So we're going to look at firms through the lens, the theoretical lens of a principal agent problem. So what was that again, a principal agent problem? Well, here we have on the top side investors, you might call the principals. The investors are going to attract an agent, a manager, who's going to make the day-to-day decisions. But this manager is the agent, the investors are the principals, but the manager and the investor might have conflicting interests. And also the manager might have better information on the inside working of the firm. They know whether the firm is doing well or is actually doing poorly. And what we'll be studying in the course is the consequences of such conflicting interests and informational problems between these principals and these agents. So basically what this boils down to, so the information asymmetry comes basically in two guises. So one guise of information asymmetry is called moral hazard, or sometimes hidden action. So the manager might take actions that are benefiting for themselves, but not for the owners or not for the funders of the firm. So the manager might engage in their pet projects rather than the more lucrative projects. The manager might want to have some perks, like having a nice corporate airplane, which might not be in the interest of the firm itself. The manager might want to hire their own spouse or their nephew or some family member, not because that's the best choice, but just because that's their own family. They might engage in empire building. There might be self-dealing, so having sort of side contracts with your own supply firms. And of course, also the manager makes an effort choice. That's going to be important, in particular, the way in which we're going to look at this typically. There will be an effort choice. So is this manager really going for this firm and spending 80 hours a week? Or is this manager taking sort of a more lazy kind of life and try to get away with what they can and spend more time in golf clinics or what you wish? So that's the moral hazard or the hidden action part. The other side to information asymmetry is called adverse selection, or in other words, hidden information. Those are basically synonyms. So the manager will have much better information on the workings of this firm. So they will know much better whether a new investment is really valuable, or whether they just like it more for some other reason, which is not in the interest of the investor. And the manager might actually also know there is some creative accounting going on, and that the actual cash flows which are reported might not have occurred in practice, but are, well, perhaps made up. So is this important in practice? Yeah, I think it is. So if you look at the news, so here's some old news and some very new news. So on top is the old one, a real life example. This is the Enron case. So it's long ago. It's the start of this century, so 2003 or 2004, I think. Enron used to be a really big company. It doesn't exist anymore. It also used to have a really big accountant, Arthur Andersen. It also doesn't exist anymore. There used to be 5 large accountants. Now we only have 4. So what happened with Enron is it was really rife with both moral hazard and adverse selection problems. So on the top you see a quote here from some newspaper article about employee perks. And there was this trader at Enron. So Enron actually was a trading firm. They mostly traded in energy. They also traded in broadband capacity, and basically they traded in anything that they could get their hands on. And there's this quote here: "We knew we weren't making money, but the extravagance, that is what made it great to work there." So there were, well, magnificent parties, etc., enormous and the nice work outings. No amount of money was too big to spend on making life attractive for those who work there. And as I just mentioned, the accountant Arthur Andersen doesn't exist anymore. There was an enormous amount of creative accounting. Once this firm fell, it turned out lots of costs were hidden from the accountant, from outsiders. Therefore, revenues were just made up and inflated to such an extent that actually the board members of this firm were actually put to trial. So Kenneth Lay and Jeffrey Skilling were the sort of both convicted to go to prison, and I think some other guys as well, actually. So this is long ago, and so it still is an important example, not only because it was so big, but also because it resulted in quite a bit of new legislation to make sure that some of these egregious behaviors cannot occur anymore. Quite new, or not quite finished yet, but still going on, is of course the Wirecard example that you might have seen in the newspaper evolving over the last couple of months. So Wirecard, of course, is this German fintech firm, which turned out to have made up basically lots of revenues which did not exist in practice, to such an extent that it's now managed by an outside assessor, and it's broken up and worth a lot more, and lots of investors are actually losing all their money over this firm. And also here, you see this right-hand picture, that was the CFO. He's now, well, this is German sign, roadside sign. This guy is now wanted by the police. So if you saw him, you can call this number if you're in Germany. Okay, so these kinds of extravagant cases, basically, they still occur. They are, of course, extravagant. That's not the general rule, but even in sort of more everyday examples, there are conflicts of interest between outside investors and the insiders. So just earlier this year, the Dutch retail firm HEMA, so basically, for those of you who are Dutch, you know this very well, it's a household name in the Netherlands. There was HEMA in the Corona crisis their shops came into financial difficulties, and actually external investors had different views of what should happen with this firm than the entrepreneur who had a large equity share in this firm as well, Marcel Boekhorn. Ultimately, in this case, the external investors won and ousted this Boekhorn investor. So there was a conflict here of interest between the outside financiers, and they intervened, and the manager, Boekhorn. Also in other cases, of course, with some regularity, I guess, there was discussion on salaries and bonuses. So ING in the Netherlands is a big bank, and like 2 years ago, there was a big perhaps scandal involving money laundering and the relation, or perhaps separately, also the bonus contracts that were awarded to the management of this firm. So again, here this is a sort of more everyday example of such conflicts of interest. So what does corporate finance or corporate governance, which is almost synonym, slight differences perhaps, but we'll treat them as almost synonym. What do they do? Well, in corporate finance, we try to answer the question, how should we design the funding contracts, so the financing contracts between financiers, outside investors, and those who are managing or running the firms? How should we design those contracts such that these funders, these investors, are assured that the managers will, on the one hand, act in the interest of the funders, their interests are aligned, and secondly, that they actually tell the truth about what the conditions of this firm and of the different investments that they plan, what they are. So in other words, how do you design a contract that mitigates these principal agent problems? So the tools that one has at its disposal to make sure to design these contracts are, well, one of them that's well known as executive compensation, remuneration contracts. So what kind of financial or other incentives can you put into contracts to align the interests of managers and of funders? Then another tool is monitoring. Have somebody else, say a board of external board members, or perhaps a bank, that is putting in some effort actually to take a closer look at what this firm is actually doing, and reduces the manager's ability to deviate from the path that would be in the interest of those who provide the cash. And also matters of control. Who has the right to make decisions, and who has the right to make what decisions? So what decisions can a manager might decide on their own, and what decisions will be taken by perhaps some outsiders? Or in a venture capital environment, so when can a venture capitalist intervene in the way in which the management is running the firm, or even replace management? Those are types of tools that we'll look into in a theoretical first type of world. So we'll look at finance theory, and then we'll also have a look at how that works out in practice in more empirically oriented papers. So some of the questions that ultimately we want to answer, some typical corporate finance questions is, well, first of all, why are not all positive NPV projects financed? So in other words, why is there some credit rationing sometimes? What can you do, or what can a firm do to boost their financing, their financeability? And perhaps that might involve some inefficiencies in how firms execute their projects. So some inefficiencies that we see in practice, might they actually result from the desire to make funding actually possible? You cannot do without this inefficiency. Think about posting collateral. It's not always efficient to post collateral for a bond or for a loan, but yet we see it a lot, and there might be a reason for this. Signaling, I talked about that a bit before already. We have a little bit of a look at why banks exist, in particular viewing banks as monitors of the firm, and then the natural next question is, well, who's then going to monitor the banks? We'll look a bit also at, or at least it's a big corporate finance question, how does information get reflected in assets that are traded, in particular in stock markets, perhaps also in bond markets, and what incentives are there to gather information for market participants? Then there is control questions, so who has decision power in the firm? So for instance, why does decision power sometimes shift? So why does decision power shift to debt holders when firms perform poorly? So if you are sort of nearer to bankruptcy, well, you might find, if you're running this firm, that all of a sudden, as you sort of do not meet some requirements, banks will step in and they will get the power actually to make some different decisions. And you might ask, will they take the optimal decisions of the firm? And you might already guess that, or know that, well, no, these firms will not necessarily be optimal for the firms, they will be optimal for the banks. Why do we have that? Doesn't sound like a good thing, but we'll figure out, some reasons we cannot do without this. So those are typical questions that corporate finance tries to answer. So to summarize what we're going to do in this objective, we are basically going to take a macroeconomic perspective, this principal agent theory perspective. We're going to look at models, in particular in the first couple of lectures. We're going to study the microeconomic foundations, the information economics foundations of corporate finance theory. And then in the end, we'll also look at some papers which will discuss some empirical applications of these theories. So in the next video, we'll sort of go through the organization of the course for this block. See you there.